ChargePoint stock is down over 96% in the last 3 years. Hopefully, you've been watching my videos in that time and you listened to my warnings to avoid this EV charging company. I've said repeatedly over these last 3 years to avoid this stock. It wasn't heading in the right direction. And despite government efforts to push EVs down people's throats, organic demand for electric vehicles is nowhere near where people had hoped and companies had forecasted they would be when they made their plans for 2025 and beyond. But is this stock price drop so much now that it's a buying opportunity for ChargePoint investors? Is the stock so cheap now after falling 96% that it offers a good risk versus return? That's the question I'll answer in this video, revisiting the company's fundamentals like revenue, profit margins, and its balance sheet, looking at the new updated lower valuation to answer the question again, should you avoid ChargePoint stock or is it finally time to buy? I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So here is that devastating price chart for ChargePoint stock investors. I sincerely hope you are not one of those individuals who got caught up in this stock. It's down over 96% in the last 3 years. And unfortunately, I know there have been many YouTubers that have been pushing this stock among other EV stocks over these last few years without really understanding fundamentals and just looking at what's popular and pushing that onto unsuspecting investors without understanding how to conduct financial analysis, how to look at valuations, and just, going on YouTube and just making talking points and giving opinions based on what's popular and what's going to get them views. Unfortunately, that does not work out well, and you're seeing the consequences here with ChargePoint stock, a disaster now, down over 96%. Looking at the company's revenue growth over the last 5 years, you can understand why the price is falling, or you can begin to understand why the price is falling. This is only the tip of the iceberg here for ChargePoint's troubles. You can see starting in 2023, revenue growth fell off a cliff. And that wasn't because there was a change in the demand for electric vehicle charging stations. Demand for these things had always been weak. But what changed in 2022 is the cost of capital. It became harder for companies like ChargePoint to go to investors and ask for more money. The growth in this business had been funded by investors like yourself, giving the company money to then invest in growth. This was unprofitable growth. This was just the company hoping that things would change in the future, and they just kept building and building and building, hoping that consumer demand and consumer adoption for electric vehicles would magically increase. But when the cost of capital increased and ChargePoint found it more difficult to raise money from investors, it was forced to scale back its growth ambitions. It could no longer lose money from you. And so it needed to tighten its belt and just focus on survival. And when it did that, you saw the revenue growth decelerate considerably as the company had to change strategy. It had to make actual deals that made sense and not just make deals for the sake of growing the business, accepting any number just to complete a sale. Now you can see 1, 2, 3, 4, 5, 6, 7 consecutive quarters where the company's revenue growth has decreased year over year. In the most recent quarter, it was down 15.5% year over year. Although this is what management needs to do, I think they're finally having to manage the business prudently. Now that investor capital has mostly dried up, they need to really focus on building a business that is sustainable, that can make sense. Not hoping that they can just keep burning through money and then go to investors and ask for more money. Burn through money and then go to investors and ask for more money. That ship has mostly sailed. And as you're seeing with the big stock price decrash, the stock market crash here on Monday, March 10th, investors are getting more serious about where they're putting their money, and they're pulling their money out of these unprofitable, risky things like ChargePoint, like cryptocurrencies, like other hopeful and momentum type stocks that were increasing in valuation just because of momentum, not because the fundamental prospects of the business were improving. Investors are now starting to actually pay attention to the fundamental prospects of a business. And if that's going to be the case, that's bad news for ChargePoint. That's because not only is revenue going backwards, but the company is still losing a lot of money on the bottom line. Negative 60% operating profit margin in the trailing 12 months. The good news is that it is improving. It is up from negative close to 90% for a few quarters, and it is improving. Although this is mostly improving because the company is not making deals anymore that are hurtful to the business. And so growth is also going to go backwards. And there's only so much that they can improve in this fashion, right? If they close down the business completely, then the profit losses will be zero, right? They won't be negative 60%. It'll just be zero. The losses on the bottom line will just be zero. So that's the kind of improvement ChargePoint is just making the business smaller and so losing less money, because previously with every sale that ChargePoint made, it just lost more money on the bottom line. And so now that they're making fewer sales, they're losing less money on the bottom line. It's not because the company has fundamentally improved the business. It's not because they learned how to operate the business, found economies in scale, gain competitive advantages. It was none of those causes. It was just the company shrinking and becoming more prudent about the sales contracts that it signs, becoming more prudent about investments in growth, and so thereby shrinking the losses on the bottom line. And as I mentioned, a lot of these losses are coming at the expense of investors. The company continues to dilute shareholders. In 2021, they had about 240 million shares outstanding. They now have 450 million shares outstanding. And I wouldn't be surprised if they continue diluting shareholders, milking as much money as they can out of the share price, selling as many shares as they can to get more money from investors and keep the company surviving, hoping for some miracle, hoping for some big change in the prospects for the electric vehicle industry. Maybe one of the companies that are developing solid state battery technology can make a big breakthrough and improve the charging speed, the durability, the long lasting, how long these batteries last before they need to be charged, etc. Some kind of miracle that really brings this industry forward, because at the current rates of increase, it's just not enough to keep all of these companies afloat. So looking at the balance sheet, you can see the company's cash and short-term investor balance dwindling. It now has only $224 million in cash, down from around $600 million a couple of years ago, and this is continuing to move backwards. And so this will continue moving downwards. The company's not going to be cash flow positive anytime soon. And it just needs to keep getting money from investors, and hopefully the government will bail them out and give them some more money to keep them alive, in the hopes of some miracle happening down the road, some breakthrough out of left field that brings the business back into viability. Because normal growth in the EV industry, the way it's been growing over these last 2 to 5 years, it's not going to be enough for ChargePoint, I don't think. And so the company is trading right now at its cheapest valuation at a forward price to sales of 0.5 and a half. And to answer the question, do I think the stock is, if the big stock price decrease makes it time to buy? The answer is no. I wouldn't touch this stock with a 10-foot pole. I still have it rated as a sell, and I'm keeping it rated as a sell. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.